While many people celebrated last week's interest rate cut, the question quickly turned into, well, great, but when's the next one? And in this episode, we're going to dive into our thoughts on when we expect that to happen, and also the key indicators that the Bank of Canada are watching to make that decision. And if you are new to this channel, well, hi, my name's Dan, and I'm here with my business partner, Ryan. And we are real estate agents here in Vancouver who have collectively sold over $400 million worth of real estate. Ultimately, we help people buy, sell, and invest in the best properties in the Lower Mainland. If you happen to have any questions about how to best navigate this real estate market, good chance that we just might have the answer. Reach out to us using the link below, and we'll connect and explore all the options that you have in today's market. Now, back to this discussion about the next rate cut. Well, let's start by looking at the GDP to help answer that potential question as to when the BOC may cut again. Weak GDP was, of course, likely one of the main reasons that the Bank of Canada did in fact cut last week, and may very well be the reason that they continue to do so going into the rest of 2024. The Bank of Canada cuts when the country is struggling and the economy is weak, and right now both of those are absolutely true. Keep in mind as well, of course, the Bank of Canada is essentially reactive. They wait until things are too good or too bad, depending which side of the fence you're on, to make a move. Inflation was well over 3% before they started increasing, and it was, well, we're in a pretty tough time now, and they've only just begun their cuts. Looking at GDP, Q1 missed the expectations. As you may have heard, it hit 1.7%, and the expectations were 2.3%. And that, of course, was right before the BOC decided to cut. But what's more important than that is that Q4 GDP data has actually been revised down now from 1% annualized to essentially flat. This means we effectively saw zero GDP growth for the second half of 2023. And it gets much worse when we break that down, looking at it from a per capita basis. GDP is essentially down 2.6%, negative 2.6% year over year when looked at it on a per capita basis. That equates to the steepest decline that we've seen since the global financial crisis and the early 90s before that. Throw on top of it the employment rate data, which has now fallen 61% since the 2023 cycle high. It is now at the lows, the same lows that we saw also at the global financial crisis, as well as that 2016 oil crash. These stark numbers would indicate further rate cuts. Well, let's look to the markets. What do the markets think about when and how much? As of earlier this week, the markets were pricing in just one more quarter point cut for the rest of this year, making it a 44% chance at the next rate announcement in July, but a 98% chance of that cut happening in September. And there are two more announcements for the year that would be in October and December, currently pricing in a hold. Though on top of that, they do think, they being the markets, that in 1 year from now, that the overnight interest rate will hit 3.75%. So that's where we're at for interest rate potential cuts, looking at the rest of this year. As of today, the data moves as we know, but right now, only one cut in September is expected.
Yeah, and I, just to comment a little bit on that, Dan, like I think most governors, when they start a rate cutting cycle, are likely going to sound or have a bit more of a hawkish tone, because I don't think they want the markets to run ahead of them. And I think that's, as we continue to unpack how the economy is actually performing, I simply don't think they have a choice based on some of the things we're seeing. I mean, you just talked about GDP numbers, not only on a per capita basis going down at quite an extreme rate, but also to factor in, revisions that instead of seeing growth, we're seeing flat, and I bet in some of those cases, it's not a great flat. It's probably trending down as well. With that said, we'll get more into that later into the pod, but let's talk about affordability right now. Understandably, a quarter point rate cut does very little to affordability, right? This is more of a sentiment shift, an indication where we're going. And amazingly, the real estate outlook index, the confidence effectively in the real estate market, has gone with it. It's now above the 2015 to 2020 levels. Canadians appear eternally optimistic about the future of housing in this country. Assuming that you've got money to get into into it in the first place. But that does feel contradictory to what we're seeing in terms of sales data. The national home sales volume, is hovering around 20-year lows. So it doesn't quite feel that way, especially from an operator's perspective. But regardless, part of this optimism is likely coming from the increase in affordability from a monthly payment standpoint. The payments required to purchase a typical Canadian home dropped from $3,550 to $3,200, which is about a 10% improvement, and back to where it was about a year ago, though the recent spike in inventory also is likely adding to a gain in sentiment. Buyers are starting to have more options to choose from, and recognizing the likelihood of prices continuing to soften, especially over the slower summer months, is going to take place. And lastly, those looking at future inventory in the multifamily segment will be happy to hear that building permit data released this week is encouraging, as permits have jumped 26% on the national level over the month. The details behind this increase were particularly pleasing, as it was driven by a surge in the multifamily segment, which hit a record high in the country to represent a new all-time peak of 84% of all permits. In British Columbia, where affordability conditions remain near all-time highs, way beyond the national average, permits for multi-units have surged to 86.3 thousand. Multifamily permits also hit a record high in Alberta, where housing is also going through a surge and remains tight because of huge population increases there. While it remains to be seen whether or not this trend will continue into the coming months and translate into higher levels of housing starts, this data offers a glimmer of hope for our housing crisis.
Yeah, it's no doubt that, of course, the country nationally and specifically the province of British Columbia are very pro multifamily, aka missing middle. So we are starting to see the early indicators that the builders are going to start bringing that product to market. Now, keep in mind, of course, multifamily can mean 2 units, 3 units, 4, 5. It's certainly not a 300-400 unit condo tower, but it is an early indicator that the intent of the policy changes and the legislation that's come into place is taking early effect. So we'll continue to watch that. Next up, I wanted to discuss a headline that was kind of making the rounds here on the internet this week. And it kind of caught my attention because it seemed a little bit clickbaity, if you will. But let's go through it here. It simply stated that Ontario mortgages in severe delinquency topped $1 billion for the first time ever. So let's unpack it. The article does go on to note that Ontario is in fact at the lowest delinquency rate across the country. That province is the lowest at 0.13%, which equates to 2,873 mortgages are delinquent, meaning 3+ months of lack or missed payments. It does fail to note, however, the amount of those mortgages that are in severe delinquency, right? So we've got 2,900 on mortgages that are 90 days plus late, but how many of those are in severe, and what does severe even mean, I guess? Anyway, it also doesn't delineate that it's not the amount of the missed payments combined that totals over 1 billion. It's the total amount of mortgages that happen to have current payments that are in delinquency that are over 1 billion. That means that, let's say, a homeowner is delayed 4 months in their payments, and that equals $30,000. Well, it's not saying that 30 grand plus all the other ones equals $1 billion. It's saying, well, this homeowner who owes 30 grand on their $800,000 mortgage, well, let's take that 800K and put that into the barrel and add that up to equal $1 billion. So a bit misleading, but whatever. It's a great headline. Now, let's run this scenario here to kind of estimate what they're calculating here. That 50% of those Ontario mortgages that are severely delinquent, okay, we'll take 50% of the total delinquent mortgages, call them severe. That equals, 1,437 mortgages are severe. You divide that by the $1 billion that they've now crossed. That means the average total mortgage for those severely delinquent homeowners is about $700K. And that definitely sounds plausible, right? $700K is fairly in line with what a typical mortgage is going to be in the second most expensive province in the country. It also made other notes of the current debts in Canada here, though, which included Canada's total consumer debt is actually at $2.5 trillion right now. Massive number. Year over year, of course, well, not of course, but it has shockingly gone up, but 3.5%. Not a massive number, but up. When we look at Canadian debt outside of mortgage, so non-mortgage debt, the average Canadian on their credit cards, line of credits, what else would they have? Car payments, etc. Totals $21,276 per person. That's up as well, but it's only up 1.8% from last year. Obviously not great, but it's also not spiraling out of control per se. Regardless, when we do look to the past, delinquency rates do typically, or not typically, always rise after we see rate cuts. Okay, and we just saw a rate cut. So definitely expect the arrears rate to increase. Yes, we're still below pre-pandemic levels and have some headway, if you will, to kind of get back to quote unquote norms. But because essentially the Bank of Canada waits until the economy is eroded to a degree that it's extreme to cut rates, well, it's just started now. So people are, a quarter point, like we touched on earlier, is not going to change affordability. It's not going to make your monthly payment suddenly affordable. So expect delinquencies to rise. How high we will see. Overall, it's not flashing red to me, and it's just going to go up, and we'll see how far it goes. We do like tracking this one quite closely, and we'll keep sharing the data with you every month as it comes out.
Yeah, and wanted to kind of continue on that theme by touching on a recent article out by the Globe and Mail here, touching on how difficult it is for the average Canadian who's scraping together as much money as they possibly can to organize a down payment and buy a home, and just how that appears to be just falling off of a cliff. So get some of this. This is a pretty interesting article. The average resale home price in April was about $700,000 across the national average here, which means a minimum down payment of about 6.5% or $26,200 was all you needed to get this home. If you went up to 20%, which is a conventional mortgage, you would be avoiding mortgage default insurance, but you would need to come up with $140,000 in difference. So there are plenty of indicators of declining housing affordability. We've just touched on some of them, but this one stands out as being both discouraging and at least very fixable with a quick pen stroke. Our mortgage system, just for some reference here, was designed to promote access to home ownership by allowing people to get into the market with as little as 5% down on a $500,000 mortgage. Though that number seems comical in a place like Vancouver, as there's almost nothing for sale at that price point. In fact, back in early 2022, there were roughly 9 locations in Canada with an average resale price point of over $1 million. And for reference, that $1 million limit was set in 2012, and prices have more than doubled since that time frame. And if interest rates fall in the coming months and prices actually respond to that, we could end up with even more locations than just 9, where the average price point exceeds $1 million. And that's going to make it even harder for entry-level home buyers to achieve this dream of owning a home in Canada. So for reference here, for more expensive homes, you pay 5% on the first $500,000 and you pay 10% on the balance up to $999,000. You're not eligible for mortgage insurance if you're above $1 million. And referencing this, insured mortgages account for 55% of outstanding mortgage balances held by charter banks in 2015. And this is a report from Morningstar. By the second quarter of 2023, insured mortgages represented just 27% of purchases. Against all logic, house prices shot higher in the past decade or so, and the market share for insured mortgages has plunged as a result. So I guess that the thing you're probably thinking is, well, just increase the limit. But, if you increase the limit for insured mortgages, this could put even more pressure on housing, specifically the demand side, and would likely continue to push prices up even further as it grants access to more expensive homes from people who cannot really afford them in the first place. And it also creates a higher level of risk for those loaning. The real answer, though, is simply something we've said for years, which is just we need to build more homes and we need to build them faster. But there's trouble here, as that's not likely to happen in the near term, as developers are just as vulnerable as anyone to the slowing economy as borrowing costs and city taxes, which we found out over the last little while have more than 5x'd. And that appetite for risk and the margins being so thin has created an environment where future housing supply is really problematic. And is it really any wonder why young people in this country find it so difficult to get a foothold in some of the major cities? It's just a clear example that affordability is the forefront of everywhere you turn here when it comes to our housing market.
On top of building more houses, our country clearly needs to build more hospitals and schools. And that's probably no surprise to anybody who's dealing with, taking people or their kids to school or having had spent any time in a hospital over the last year or so. The wait times are almost unfathomable. And it does feel like it's really kind of happened over just the last couple of years with the extreme levels of immigration that we've had. Though I wanted to pull up some data and share some numbers with you that kind of shows that this has just been a degrading sort of segment of our country for honestly over 40, 50 years here. Take, for example, the amount of hospitals in our country on a per capita basis. So the information, the data we have goes back to 1995. So we've got, 30 good years of information here. Back in 1995, there were 31 hospitals for every 1 million people. It's basically been, though, a straight line down since then. Like the numbers just go down year after year over year. The data we have goes all the way up until the year 2021, where there are now just 18 and a half hospitals per 1 million people. So a 40% decline in hospitals over the last 30 years, based on, of course, the rate of growth versus the rate of population surge. Again, that's before the last 3 years where we've seen 2.5 million more people enter the country. That gets worse when we look at it on a per bed basis. This data actually goes back further, all the way to 1976. So we've almost got 50 years of data here. And in 1976, for every 1,000 people, there were 7 hospital beds available. Fast forward to 2021, for every 1,000 people, there are only 2.5 beds available. A 65% decline. So it's no wonder that when you have an issue and you go to the hospital and it takes 8 hours to be seen for a non-urgent issue, the numbers are definitely reflective of that. And we all feel it. And unfortunately, I couldn't find the school data, but I would not be surprised if it's similar.
How is someone like an immigration minister not looking at a report like this before deciding to bring in millions and millions of people and making it arguably exponentially more difficult for that entire sector? It just blows my mind. I mean, you would think you would be bringing in a proportional amount of doctors required to service the new amount of people, or some sort of metric that corresponds to this. But this is just a straight line down, and the quality of life is declining at a arguably accelerating pace. It's kind of scary. And more on kind of our failing economy. The second story we're going to talk about today is a recent report by economist David Rosenberg through the Financial Post here, essentially talking about how the Canadian economy is really in tatters, and the central bank, much like Dan alluded to earlier in the segment, has been very slow to respond and is often using lagging indicators when they're forward looking. So there are some pundits who believe that the Bank of Canada will end up reigniting the housing market by dropping rates. I mean, it's been a common sort of counter argument to dropping rates, but that's hardly going to be the case with mortgage credit availability also drying up as banks record a ton of loan loss reserve provisions on their balance or income statements. To reiterate, the market is priced for only 2 cuts in the next 4 meetings. But consider this. The 6.2% unemployment rate, comparatively speaking to 5.5% just before COVID back in 2020, puts us in an interesting position. Back then, the CPIX, which is the most important core inflation metric that excludes the 8 most noisy or volatile metrics was sitting at 1.8%. And today it's sitting at 1.65%. But the restriction we have on credit is exponentially higher. The bottom line is that the Canadian economy is either in a recession, much like we've just heard the revisions to the GDP outputs, or on the verge of slipping into one. The unemployment rate has climbed 140 basis points from the cycle low of 4.8% to 6.2% over the past 6 decades, and this covers 5 recessions. Not once was a recession avoided with this sort of increase in the jobless rate from its trough. It may not be a stretch at all to think that the central bank has a whole lot of rewinding to do. Certainly, they've announced that. But no matter how you slice it, rates are still far too high when benchmarked against where activity and inflation currently reside. Historically, the Bank of Canada has kept a policy rate roughly 50 basis points above the inflation rate. Using that as a benchmark, that means that the rate should be closer to 3% versus the 4.75% that we're at now. And seeing as many measures of the core rate suggest we are on course for a 2% midpoint of the range, David Rosenberg believes this cycle could likely see that overnight rate touch as low as 2%, and that's him being conservative. Again, he is has had that position for a long time. The proof will be in the pudding in the coming months, Dan. So interesting take.
Absolutely. And of course, with these current high rates, it's affecting the real estate investment market and has for some time. And I want to kind of end on a segment about real estate investors and ultimately how that's going to reflect in the condo market and condo inventory. Understandably, typical cash flow on condos has been negative for a few years here, dating back to about 2020. And so a number of condo investors, based on these higher rates, have decided to offload these negative cash flowing investments. And this is really noticeable, of course, in Toronto. And Toronto has also seen a huge spike or surge in recent condo towers completing. And as the vast majority of these condos are purchased pre-sale by investors, when 5-6 years ago things were maybe a little bit more positive with the outlook, when they come time to close and their mortgage rate is 6% and rental rates are peeling off, it's not too much of a surprise that investors are putting these on the marketplace. Where, of course, right now in Toronto, they have an all-time high in active condo listings. And the thing is, too, this is not sort of a blip on the radar in the sense that condo completions are set to increase over the next couple of years, right? There's a lot of buildings that have been under construction for 3-4 years here. They're completing in 2025. They're completing in 2026 to a tune higher than the total amount completing in 2024. So understandably, you can expect that segment of the market to see likely a significant drop in price coming in the next few years here. Supply and demand economics say that the condo market might take quite a hit in Toronto when, again, they're already seeing all-time high inventory. As mentioned, the appetite here for investment condos has been dropping a lot because of this negative cash flow. And we've been kind of reporting on this and sharing the chart for some time, but it does appear that the cash flow rate on a typical condo in Toronto, based on typical mortgage rates and typical rental rates, it's the amount of negative cash flow may have hit bottom. We may have seen a cyclical low be hit, and it's bouncing back up. At its worst, that typical sort of mathematical equation, if you will, for a Toronto condo represented about a negative $1,250 per month to that owner, taking all expenses included there. It's improved slightly now to about minus $1,050 per month. Still not great by any stretch, but improving. Now, if we do see lower prices over the next year or two, combined with a lower interest rate, we may see some people shift back into that marketplace. But again, to begin being truly appealing to investors, you got to think the cash flow has to go positive, or at least close to that again. And what's the likelihood of that happening in areas like Toronto and Vancouver? Pretty tough. I mean, ultimately, if it costs $600,000 to get into that condo, and you need to come up with $130,000, $140,000 to close just to experience minus $1,000 per month, well, why not just go into a GIC and kind of guarantee yourself 5% right now? understandably, the amount of investment moving away from real estate right now is pretty substantial and could continue because there's just better places to get better returns. There's no doubt about it. So I think that's where we're going to end it today. Always fascinating in this real estate market. Lots to talk on. We'll be here next week with more information. Thank you, as always, for tuning in, and we will see you here in 7 days.